Now, let's discuss building block model. I know that students get confused by it a lot. Well, that is because it has some blocks, dimensions, standards, rewards, and how are these all interrelated? How can we apply that to performance management? And how is it going to be tested in the exam? Okay, just if you feel that you really like the video, please put like so that I know that there is a human being watching. And if you want to motivate me to record more videos where I explain the logics behind all this advanced performance management stuff, then subscribe, and then I will know that there are people who are looking forward for new videos to appear. Okay, but coming back to the model. Any model is basically a checklist. So look, what is the problem that a company faces? They need to come up with some KPIs. Everyone is crazy about KPIs and they want not to miss anything. So if they learn that you're an accountant, they will ask you, okay, I have an IT company. What KPI should I use? So basically, models like that, they list the type of KPIs. And as such, if we have a question that is formulated as how this model will help, then the key to the answer is to say that by highlighting this type of measure, by pushing the companies to make a measure that answers that, the companies will aim for their success. So what do we have here? We have here results and determinants. We have results, meaning that these are the KPIs that are going to measure what has already happened to the company. So these are called downstream results, and this is competitiveness and financial performance. And how will this company improve the performance or performance management or performance measurement of the company? We need to use this word by praising the importance. This word, by praising the importance, is the glue that will allow you to actually formulate the thought, to glue together, to stick together all your ideas. So by praising the importance of including KPIs that are aimed at financial performance, the company will ensure that it satisfies its key stakeholders, its shareholders. And then we will need to apply this model to the scenario, and you will need to explain why financial performance measures are important. And if you have a listed company, you will say that for a share price not to fall, the company will need to ensure that its performance is aligned with the financial goals set. If it is a family, then you would say that family relies on the company to pay dividends to support their living, and as such, the company needs to ensure stable financial performance to do that. So again, praising the importance of looking into financial performance to satisfy shareholders. As for competitiveness, we will say that this company is listed, or it's just started the business, or whatever happened to it. Well, you will sign the scenario. You say it is very important for it to look at competitiveness. And as such, by praising the importance of setting KPIs that are aimed at competitiveness, the company will ensure that customers are satisfied and as such are willing to they can support companies' financial performance, that they are willing to buy in volumes and in gross profit margins that are required. So these are the results. This is like the two key types of performance measures that we are going to set. Now, what about the rest of those? The rest are called determinants, and we call them upstream. It's not really important, but still. And these are critical success factors. So something that has to go right for the company to be able to achieve those results. So then you would say, as the company is a differentiator, it is important for it to have a certain quality of service to be able to attract the customers. By praising the importance of including quality of service KPIs, this company will ensure that competitiveness targets are reached. The same will go for flexibility. So we will need basically flexibility to satisfy competitiveness, to satisfy the demands of the customers. And let's have an example. So for example, I teach ACCA and I'm flexible. I can do that for big groups, for small groups. I can just teach theory, or I can review the work. I can teach APM, SBR, and so on. So this is about flexibility, and as such, I can satisfy my customers better. Well, for example, have long classes where we are going to cover 2 subjects at a time. Resource utilization is about waste. It's about idle time. So the more flexible our people are, the smaller is resource utilization, and also the better is resource utilization, the better is our financial performance, because we do not need to pay for idle time. Idle time is a key feature here, because this model, this building block model, is more about service organizations. So if I am able to teach various kinds of subjects of ACCA topics, then my idle time will be small and your resource utilization is high. And from the perspective of critical success factors, I would, to satisfy financial performance, to get profit like that, I would need to limit my salary cost, for example, and as such, I would need to have this resource utilization. So I would need to have certain productivity. So I would need to, for example, teach 100 hours a month to be able to get enough revenue to compensate for salary cost. Innovation, well, again, you will look into the company, what it is engaged into. So, for example, if it is training, then new products, new features, new parts of syllabus can appear. So it would be vital for the company to be innovative, and that can be measured, for example, by hours of training attended, or new products offered, or something like that. So these are dimensions. As for the standards, standards are the target, the numerical values. So if we talk about dimensions, we say market share, we say, let's say, net profit or gross profit margin. But when we talk about standards, we talk about the numerical values. So for example, market share of 20% or net profit of 1 million and so on. So when we talk about standards, this model praises the importance of the features of the standards, of how this company sets the numerical values for its performance measures. And first, there has to be ownership. Ownership means that if this is the target that I'm going to be assessed against, then I, as a manager, need to participate in this discussion of the level of the standard. So if we have a manager who is responsible to bring us revenue, it's not that we will tell him or her, bring us 10 million of revenue. No, we will discuss, well, okay, so last year you brought us 7 million. Well, how much do you think you can bring us this year? And what can you do to bring us more revenue? Okay, how about we set this target, because it will still be achievable, but though it will be challenging. So that is about the ownership. Achievability means that this target, as we've already discussed, needs to be challenging but achievable. So we need this target to be motivating in terms of numerical value. And it has to be fair. Fairness means that this target, the level of targets need to be set across organization evenly. So, for example, if we have a revenue target for sales manager, it should be as hard to achieve as, let's say, productivity target for production manager. And of course, it is hard because these are uncomparable things, but still, it cannot be that one person gets their target just by itself. The target is achieved by itself, and the other really has to work. So these are the numerical value of the performance measures that we are setting in dimensions. And rewards. Well, rewards is how to motivate people with money. So when we have a bonus scheme, the bonus scheme, well, first of all, it's about how much money for what. So this bonus scheme has to be motivational in terms that the level of the reward should be appropriate. So for example, if you tell your managers that they will get $100 bonus for the year, they would say, $100, I do not really want to do my best for $100. This is not motivational. If you tell them that the bonus will be, let's say, a monthly salary, well, then maybe it's motivational. Another thing, it's not about the value, it's about the probability. So and it's about perceived probability. So for example, I'm a sales manager, and before I worked for the company where I sold toilet paper, and my sales amounted to $100,000 a month. And then I come to another company that sells, let's say, iron. And my boss tells me that I need to sell for 10 million. Oh, and my brain just collapses. I say, whoa, no, I cannot do that. Like $100,000 is the figure that I have in my mind. But what the manager was supposed to do, they were supposed to discuss with me this target so that I would understand how to achieve that, so that my perceived probability of this target would be higher, so that I would think, okay, so I would need to participate in this tender and then do that and then send this and so on. So now I understand that, and maybe it's a probability of 80%, and this target is motivational. Controllability, it means that this target should depend on my efforts and not on anybody else's. So for example, if we set a target such as net profit, then managers would be upset about it because net profit is influenced by the effort of various managers. So it's the effort of a sales manager and the production manager and purchasing manager. And I, as a manager, may be demotivated. I would say, hey, I will not get to this profit because everybody else is not going to add in as much effort as I do. So I do not really care about walking extra mile. So ideally, I should have a target and a bonus that's I can control. So if I'm a production manager, then it's going to be about idle time or about waste. And of course, we know that actually each and every target, the level of each and every target can be controllable not only by one manager. Well, for example, when we talk about materials wastage, if procurement department buys better materials, then maybe our waste will be lower, rather than if our procurement department buys poor quality of materials. Well, but still, like the idea is like that, controllability. And clarity. So if your bonus is formulated as 10% of revenue plus 2% of bonus minus this divided by this times that, then nobody will understand how to achieve this bonus, because it will be really hard for them to understand what effort to take. So the bonus scheme should be very clear to everyone. And that is Fitzgerald and Moon's building block model. So basically they say, hi guys, here is the checklist of what are the types of targets that you need to have. And this is how you set the numerical value of targets. And this is how you introduce money aspects to the targets. And that is it.